I said you're drinking Colombian decaf coffee crystals.
Colombian decaf crystals? You don't do that. It's real coffee in a big D energy mug. And by the way, my name is Dave, so it's justified. Anyway, the topic for today is about an article that I saw this week that said, I'm considering investing $1 million in QQQI. And it made me think, right now, at this point in time, where would I invest my money? It certainly wouldn't be all in QQQI, although I do own that ETF and I might add to it. But what would I be buying now that we sit here at the top of the market again? We set all new time highs, right, in the S&P 500, in stocks like Nvidia and Microsoft. So where do we go from here? So let's have some fun and figure out where we're going to invest our $1 million. I do wish the Bare Naked Ladies were here because they have great ideas like lemmings, emus, Dijon ketchup, if I can remember right, limousine just because it costs more, and a monkey. Haven't you always wanted a monkey? Anyway, that is what you're looking for. Please stick around.
Will I buy you a monkey? Haven't you always wanted a monkey?
And I'll be honest, no, I haven't always wanted a monkey. It sounds like way too much responsibility for a guy like me. But just to be honest about this question, this is a wide open question that really depends upon a bunch of factors in your personal situation. So mine is going to be different than yours. For example, how old are you? What's your current income? What's your net worth? What's your current asset allocation? What are your retirement goals? Just to name a few. So we can go on and on with this. But all I can share with you is what I might consider doing right now for myself. And to simplify the question, I'm going to limit it to stocks, bonds, and ETFs and try to gauge it more towards the everyday investor that just wants to set it and forget it, maybe put it into a few different ETFs. We're not going to talk about alternatives like real estate. And, I'm likely to dump this into a bunch of option trades, but I'm not going to in this situation. I think I'm better off just buying some simple ETFs. And of course, if you get any benefit from this, please like and subscribe to the channel. But whatever you do, don't hit that button. It's like the Colombian decaf crystals button.
What? You son of a bitch. You no good damn bitch.
Somebody needs to get Chris his coffee, and I know I'm a bad actor, but what I am is a relatively conservative investor, and I like to buy value. But I don't want to buy value right now. I don't think it's on the list. Instead, I'm drawn to the tech sector and many of the largest tech companies that we all know so well. And I think that the rich will continue to get richer at this point. So despite many tech companies having really rich valuations and hitting these all new time highs, I believe that this is the place to invest. And I don't feel any FOMO. I just see tech as the best option with growth and still more upside. So I like Microsoft, even as it hits new all-time highs. I like Meta, I like Alphabet, I like Nvidia. Speaking of Nvidia, semiconductor stocks and anything that's AI related is certainly on my list. Now there will be breakout stars within those AI stocks, but I'm not going to try to pick those individual stocks at the moment. I also like energy infrastructure and utility companies that are going to benefit from the AI boom. And utilities, these are also going to offer me some defense should things fall apart. So where is the largest chunk of my $1 million investment going? It's going to go into base ETFs based on tech. And I've got 3 examples for you right now. VGT just happens to be one of my largest holdings, and I would add to it. Okay, so this is going to have holdings, lots of stocks that you know about, like Nvidia, Microsoft, Apple, Broadcom, Palantir. Okay, so there will be overlap between the 3 that I'm showing you. So it depends on how you want to approach this, but you'll have some diversification across the 3. Now this is the least expensive to own. The expense ratio is 0.09%. So I load up on this in a couple different portfolios that I have, and it's performed really well. If you go out to like a 10-year chart, for example, up 500%, and I think the trend will continue. So I will continue to add to this. Another example is SMH. I just talked about this in my last video. I'll link that up above. That was about selling puts on SMH against SMH. And I've already made a nice profit from that because this is on a nice uptrend currently. So this is going to overlap a lot with VGT and it costs you a little bit more. So it's up to you if you want the diversification of adding SMH and having something more focused on just semiconductors, or if you just want to go with VGT. That would be understandable. I could see just doing that. Another good example, if you're really into AI, is XAIX. This is the X Trackers Artificial Intelligence and Big Data ETF. Same expense ratio as SMH. Holdings in this one, again, you're going to have some overlap, but you're going to have some diversification here, and you're going to have things like Bank of America Corp, which sneak in there. And Meta, Microsoft, Nvidia are also in there too. Pretty well balanced and has 96 holdings in it. So kind of an interesting way to pair it up. But between those three, that's going to get a large chunk of my money. I'm looking to grow, but maybe I'm also looking to add some income. So let's look at that next. Now, to pair up with those three base ETFs, I would also buy some covered call strategies that I found work well for me and have performed well. So I know I have some income investors out there. These are the three that I would pair up with this. And if you want a lot of income, you have more of this. If you want to be more long stock, and you buy those base ETFs. What I like to do is kind of mix and match a little bit. Every time I buy some growth, I also add some of these along the way. So my first one here is QQQI. That was the subject of the article in the first place. And Neos puts out some good products, and I like this one. It's got an expense ratio of 0.68%, and it distributes 14% over the last 12 months. So about 1%, a little over 1% every single month. And it's done really well. Along with that, I also like GPIQ. This is from Goldman Sachs. It's a little over 10%. Expense ratio is lower at 0.29%, and it's performed well. And my last one in this list is BALI. This is one from iShares. Again, we have three different strategies, three different option strategies, but altogether these three have performed well. Expense ratio on this one is 0.35%. I can live with that. The performance of all three of these over the last 12 months, they're all positive. In addition, you've got a distribution. If you add the distribution rates together and you divide by 3, you're at a little over 11% distribution rate. And from a tax perspective, you're about an 11% tax rate based upon the video that I did, which I'll link above. You know, I do a lot of videos. This video right here is one that I go back and I reference quite often. So GPIQ, QQQI, from a tax perspective, when you look at return of capital, we're very tax efficient. BALI was the worst of those three as far as a tax perspective, but overall about 11% is what I figured my tax liability was between these three. So it comes off tax efficiently, and they've performed well, up about 12% on average across all three products. So pairing that up with some of those longs is quite attractive to me. The next area that will get a chunk of change for me would be utilities and energy infrastructure. Again, we're long tech, right? We just bought a bunch of tech. We need something defensive that also has opportunities for growth. I think you're going to find that here in the utility sector. So this is the Spider Fund ETF XLU. Cheap to own, and it's going to give you exposure to things like Constellation Energy, which has a lot of upside potential, but also things like Duke and AEP. They're likely to profit from energy demands that are coming down the road. So over the last year, this is still up 18%. It had a very good 2024-2025. It also pays you 2.8% yield, so up over 20% over the last year. So it's already performed well. Will it continue? I think so. It has some of my money. It's going to get some more. So that's XLU, quite simple. Then I've talked about a lot of different MLPs. 3 that I buy that'll give you over like 7.5% average yield if you're an income investor would be ET, and again, tax efficient. There's Energy Transfer. I've also been buying EPD, which is Enterprise Products Partners. And finally, PAA, Plains All American Pipeline, is one of my latest additions. So all these have a nice amount of yield, and performance has held up pretty well, and I think they could benefit from the AI revolution moving forward and all these energy demands that we're going to be putting on what we have here in the United States. By the way, all the charts I've been showing come from Seeking Alpha, and I am a Seeking Alpha affiliate. Personally, use Seeking Alpha every day, not just for getting updates on the market, but also for research on the many alternative ETFs that I cover. So If you are looking for a stock and ETF research tool, consider seeking alpha and check out the links below for discount offers. And finally, with the scraps remaining, I think we're getting near the end here. I would add some IBIT. I consistently buy Bitcoin. It's a dollar cost average kind of play for me. When I do buy any kind of chunk, I usually enter with an option color, so I hedge myself. But I'm still growing this position. I think this is a place where I need to have, a small percentage of my money invested, just in case. I can live without it if something was dreadful to happen to Bitcoin, but otherwise I want some exposure. In addition to IBIT, if you're looking for some fixed income, I just talked to Jay Hatfield this week from Infrastructure Capital Management about his popular ETF PFFA and some of his other funds. And over the last 5 years, PFFA has returned about 85%. So not quite keeping up with the S&P 500, but when it comes to preferred stock or fixed income, it looks like one of the better options out there. Now this one's slightly leveraged, but he does a good job. He's got a good management team over there. After talking to him, I have more confidence in something like PFFA. So haven't bought it yet, but I would consider it. And then other fixed income, just to throw something up here for fixed income investors, LQD is something that I do own, but when I use LQD, I also do use it with options. So I'm always looking to exceed something that is down here, this 4.4% yield. I'm looking to enter at a lower price by selling puts. When I own it, I like to sell covered calls, again, to try to enhance my yield. But LQD is a small portion of my portfolio, and I always put something into some conservative funds. So this would be one example. So there you go, $1 million fully invested, no money on the sidelines. Let me know what you think about my choices down below. Now, if you are an income investor and you want to gear this more towards income, you could easily shape this to probably give you a 7% distribution rate. If you're more towards growth, you don't want any tax implications at all, you could really sit over there in some of those growth ETFs and let it rip, especially if you have a long timeline till retirement. Maybe that's all you need to do and keep it quite simple. But yeah, let me know what your thoughts are. And if you like this type of thing, like and subscribe. But don't click that button.
Cause I'd find you.
Thanks so much for watching. Have a great night. Take care. Whoop.